Hi guys, I wanted to make this video quickly because the vaccine has come, and in this video we'll cover the market reaction to the vaccine and the impact it has on our investments. Though being a scientist, guys, I am fascinated with the science, and so I'll have a second video somewhere probably on this which looks a little bit more deeply at the vaccine. But hit the subscribe button while you're here to see that one, I suppose. But let's get into this. Hi, I'm Fifi, a mum engineer consultant living in London, and I make videos about saving money, investing and understanding the economy to make better financial decisions. Pfizer have done it first with their vaccine trial and delivered the voom to the market. Last week was pretty crazy, I'm not gonna lie. And I have to say, they're working quite fast too, both for the commercial advantage of being first, but also, and most importantly, giving us the sweet release from this horrible virus that we've been suffering with, honestly. So let's sprinkle the facts then. So it's projected that about 50 million doses will be ready by the end of the year, which is amazing, but it is a mere droplet in the ocean because the plan is to have about 1.2 billion doses prepared by the end of 2021. So that in itself has raised massive hopes that the end of the virus is near and we can see the light at the end of the tunnel. So cue the party in the market. Just kidding, guys. The MSCI All Country World Global Equity Index, or is it the MSCI A11? Who knows? It sounds like a road name. It's a global equity index. That's all you need to know. And it closed at an all-time high. So the S&P 500 also set new records, and the FTSE 100 has pretty much crossed over, what was it, 6,000, which was adding 6% in 2 days following the announcement. So that gives you a little bit of perspective. While I'm here, I should probably mention the European Stoxx 600, which also hit an 8-month high, and oil prices leapt 9%, and Japan itself hit a 29-year peak. Gosh, and it was a crazy party last week. But as history has taught us, markets react first, and they bloody well did, I'm not gonna lie. Having said that, it wasn't glorious everywhere. The Nasdaq fell 1.5%, the index that has probably benefited the most from the work from home boom, and Zoom itself plunged by almost 20%. And in contrast, those companies that suffered the most, like food and travel for instance, had some amazing performers. Rolls-Royce was up to 43%, and the SSP group, producer of food for travel, was up about 52% too. So we should spend a little bit of time talking about this and the sudden shift away from the tech stocks even. You know I'm a huge fan of the FANGs anyway, but the week of Pfizer news was a big diversion. FANGs underperformed the S&P by about 8%. We did talk about this in another video where it was notable to see a K-shaped recovery, and I'll try and link it at the end somewhere, where tech was pretty much outperforming everything and everything else was dropping during the pandemic. Now the expectations have reversed, and those neglected areas of the market are seeing reflation. So the question is, will we see investors move away from overvalued tech to cheaper, more cyclical stock? Who knows? Mayhaps they will. And so does that mean value investing is back? Who said Warren Buffett had lost his touch? Not me, obviously. I would tend to agree with the research generally that we're not quite over the hump yet. While we and the market are eager to turn the page, the reality is the road to recovery will be volatile. However, and there's always a however, like, you know, we should see the markets and value stocks recalibrate over the next 12 months. And so as investors, we should think and plan as to how we invest in the market. So personally for me, that doesn't change much really. I haven't got a lump sum to pile in, so we'll steadily continue to buy in every month through my dollar cost averaging or pound cost averaging, what have you. And before we talk a little more specifically about Britain, it does feel like the beginning of the end. Touch wood, touch wood. Comment down below if you disagree, but I have to say a 90% efficacy rate for the vaccine is as good as best case scenario that we will get. And with all the pre-orders from the governments around the world, Pfizer is pretty much well positioned to meet the demand. Likewise, we have to remember AstraZeneca, for example, and Moderna are also currently in trials. So we should have more diversity in solutions and not all our eggs will be in one basket, hopefully. We have to remain cautious because while the virus isn't beaten, it is beatable. And so we should, for a moment, enjoy that tiny little mere fact, right? Now, as a UK-based YouTuber, can I call myself? I always feel a little bit weird calling myself that. I should talk about what's happening in the UK. Well, The second round of lockdowns has meant a fresh bout of money printing. So the Bank of England injected a further 150 billion into the economy. So that's another 20% on what was already out to make the total amount of money printed in this quarter end, I suppose, to a total of 895 billion. That is insane, guys. That's 40% of the UK GDP just printed. And the bank is also forecasting that it won't be until Q1 2022 that the UK economy will return to pre-pandemic levels. Again, I'm just sprinkling the facts out there. So the government spending continues to trend higher, and the bank has printed 3 times what we spend on the NHS in an entire year. And it's the scary part of economic policy, which has been undertaken with scant public debate, I have to say. But there you go. I'm not an economist. I just read the facts and tell you guys what's going on. So while we're here, I should talk about the UK equities too. So they look quite interesting. With the real lack of tech stocks, the FTSE has been hammered and trading at a major discount to the rest of the globe. We should note that the M&A, so that's mergers and acquisitions, this is where companies just take over one another. They will be on the rise while the UK remains quite cheap, and probably something the government will step into control at the end of the day. I have to mention Brexit because we also have that to contend with. While most developed countries simply don't have to deal with a restructure of their global trading partners. That being said, the underlying comfort is that blue chips in the FTSE 100 generally earn about 70% of their revenues from abroad, which I think makes UK an interesting long-term opportunity as we realign to the globe with all our relationships. As we do prepare for this recovery, I have to say it's a good time to refresh on dollar cost averaging, investing, and reminding ourselves of the tech overperformance. And I need to
like I was saying,
it's a good time to remind ourselves of things like dollar cost averaging when we're thinking about our investments going forward. You can watch these videos. Go ahead, let me know down there in the comments below what you think. Don't worry, I have made it easy for you. Here they are. Thank me later.